Welcome to Griffonomics.
Glad to be here for this one.
And welcome to you, the listener, to this custom deep dive. I want you to imagine something for a second. Imagine losing $2 billion of your company's value in a single afternoon.
Which is just, it's unfathomable for most of us.
Right. And not because your flagship product failed or, you lost some massive lawsuit, but literally because you changed the way you formatted a financial spreadsheet.
Yeah, a technical reporting shift. It's wild.
It's completely wild. So today we are setting out on a very specific mission. We are unpacking CoStar Group's dramatic strategic pivot. This is a company attempting this massive high-wire act, moving from a very comfortable commercial real estate data monopoly into what they hope will be a completely dominant residential technology platform.
And Wall Street analysts are basically calling this the residential inflection. It is a massive high-stakes transition. We're looking at a fundamental rewiring of how this enterprise operates.
Exactly.
I mean, how they allocate capital and how they plan to disrupt just an entirely different sector of the real estate market.
And to figure all this out, we have a towering stack of sources to go through today. I mean, we're looking at their Q1 2026 earnings transcripts, the 10K and 10Q filings, which for the listener are basically the heavily audited, legally binding financial report cards these public companies have to file with the government.
Right, the dense stuff.
The really dense stuff. But we've also got some very spicy public letters from activist investors and detailed strategic investment matrices.
There's definitely no shortage of drama in these documents.
Oh, absolutely not. So our goal for you today is to basically cut through all that noise, translate the corporate jargon, and look past the market panic to answer one really critical question.
Which is, is CoStar Group currently a value trap to be avoided, or is it a generational buying opportunity?
Exactly. Okay, let's unpack this by looking at the foundation of the company. Because before we get into the residential drama and the missing billions, we have to understand what actually pays the bills here.
Right. You have to start with the commercial segment. Brands like CoStar and LoopNet.
Right. And to put this in perspective for you, I want you to think of this commercial segment like a public utility.
Oh, that's a good way to put it.
Yeah, it's like the water company or the power grid, but for the commercial real estate world, it is highly defensive. The industry absolutely relies on it to function, and it just quietly prints cash in the background.
It really does. That segment is the financial engine of the entire operation. It's what makes everything else they're doing possible.
And the numbers are staggering. We are talking about 317,000 users. And, get this, a 92% renewal rate for their flagship product.
Wow.
When you have 92% of your customers renewing year after year, you aren't just selling software anymore. You are an essential piece of infrastructure.
You're the plumbing of the industry at that point.
Yeah.
And the financials completely validate that utility analogy.
Yeah.
I mean, in just the first quarter of 2026 alone, that commercial segment generated $161 million in profit.
Just massive.
Right. And what's fascinating here is the sheer efficiency of that revenue.
Yeah.
They are operating at a 34% adjusted EBITDA margin in that core commercial business.
And let's just clarify that term for a moment for everyone listening. Adjusted EBITDA is essentially a metric investors use to see the raw, cash-generating power of a business before taxes, interest, and all those weird accounting quirks get involved.
Exactly. So a 34% margin is a highly lucrative, incredibly defensive cash flow engine. It acts as what analysts call a core compounder. It provides this immense financial security that allows management to take these massive, aggressive swings in other areas.
Like residential.
Exactly. Specifically, that commercial cash is directly funding the company's staggering $550 million annual investment into their residential platform, Homes.com.
And that $550 million price tag is exactly where the conflict starts because, not everyone on Wall Street was super happy to see the cash from the highly profitable water company being diverted to, basically build a completely new residential city from scratch.
Yeah, investors generally don't love it when you take their steady profits and use them for a massive, risky pivot.
Which sparked a fierce proxy battle. We saw major activist investors stepping in, specifically D.E. Shaw and billionaire Dan Loeb at Third Point.
Heavy hitters.
Very heavy hitters. And for you listening, when we talk about a proxy battle or activist investors, we aren't just talking about angry shareholders sending customer service emails. These are billionaires and hedge funds who buy up enough stock to legally threaten the board of directors.
Right. They try to force their way into the room.
Yeah, they write these highly publicized open letters to rally other shareholders, and they essentially try to hijack the steering wheel of the company to force management's hand. So what was the core of this reckless drain narrative that these activists were pushing?
Well, the activist criticism really centered on two big things. First, the massive volume of capital being spent, and second, a perceived lack of transparency about what that capital was actually buying.
Right, the reporting changes.
Exactly. D.E. Shaw published this very aggressive open letter, heavily criticizing CoStar for a sudden change in how they reported their financials. Previously, CoStar reported their business based on geography like North America versus international.
Okay, makes sense.
But suddenly, they shifted to reporting based on product lines, so separating the commercial business entirely from the residential business.
And D.E. Shaw did not like that.
No, they argued this change was a deliberate smokescreen. They thought it was designed to obscure persistently underperforming numbers at Homes.com. And furthermore, management abruptly halted the disclosure of net new bookings for the residential side.
Wait, what exactly is net new bookings in this context?
It's basically the crucial metric showing exactly how many brand new contracts they signed that quarter. It's the ultimate growth scoreboard. And D.E. Shaw pointed out, look, management claims to be focused on accountability, but you can't have accountability if you take away the most transparent growth metric.
Right, and when you start hiding the scoreboard, the crowd naturally assumes you're losing. And the market completely freaked out over that lack of transparency. Following that earnings call where management basically refused to provide the segment-level bookings data, the stock dropped 9% the very next day,
Just a brutal sell-off.
which erased nearly $2 billion in shareholder value in a single trading session. That is the missing $2 billion I mentioned at the top of the deep dive.
And that's when Dan Loeb and Third Point really turned up the heat.
Oh yeah, they pounced.
Loeb wrote a letter explicitly calling the Homes.com investment and this is a direct quote, a reckless drain on a majority of the company's operating income. The demand was clear: focus on the 34% margin commercial business, stop the bleeding, and wind down the residential gamble entirely.
It had to be a moment of just peak vulnerability for the company. Which brings us to a massive irony as we transition into the Q1 2026 financial reality.
Oh, the timing on this is incredible.
It really is. So Dan Loeb and the market are screaming about this $550 million hole in the boat, right? But when we actually look at the Q1 earnings, we see something totally bizarre. That very same financial reporting shift, breaking out the commercial and residential products, that triggered the panic, is exactly what proves the company is actually incredibly healthy today.
It's the ultimate plot twist.
It is. How did a transparency issue that caused a $2 billion panic end up providing the exact benchmark for the turnaround thesis?
Well, it really all comes down to the power of isolation. Think of it like looking at the accounting books for a massive restaurant. Before the reporting shift, the activists saw all this money going out the door and thought the entire restaurant might be failing.
Okay.
But when CoStar was forced to report the residential segment on its own, it provided clarity. This isolated reporting proved that the main dining room, the commercial segment, is fully booked, wildly successful, and posting that $161 million profit.
So the core is totally fine.
More than fine. Management is simply taking a portion of those profits and burning them to build a brand new high-tech drive-through out back, which is the residential segment.
Right.
By quarantining the numbers, investors could finally see clearly that the commercial core was not deteriorating at all. Right next to that $161 million profit, they could see the residential segment posting a loss. But, and this is key, it was a narrowing loss of $29 million.
So the core business was intact, the losses were shrinking, and the overall Q1 numbers completely reflect that underlying strength. I mean, they absolutely crushed the estimates.
They really did.
We're looking at $132 million in overall adjusted EBITDA for the quarter. That actually doubled year over year. And it was a $17 million beat over the high end of their own guidance. That is simply not the financial profile of a company in crisis.
Not at all. And if we connect this to the bigger picture, that massive Q1 beat leads us directly to the absolute most important bombshell of the earnings call.
Oh, the big announcement.
Yes. Management announced what analysts are now calling the strategic inflection point. They provided official guidance that the controversial residential segment, the very thing Loeb called a reckless drain, is going to cross the threshold into profitability in Q2 2026.
Wait, really? Just like that?
Yeah, they are projecting somewhere between break-even and $10 million in positive adjusted EBITDA for residential.
That is a critical turning point for you, the listener, to understand. Because if that residential segment hits break even, that $29 million anchor that has been dragging down the overall company margins, it just vanishes. The drain stops completely.
Exactly. The fundamental mechanics of the company's valuation change practically overnight. They no longer have to use their commercial monopoly profits to subsidize the residential expansion. Instead, you suddenly have two independent, self-sustaining engines generating positive cash flow.
Okay, here's where it gets really interesting. How do you go from a massive cash burn that literally has billionaires writing angry open letters to sudden profitability in just a few quarters?
You have to look at the user adoption.
Right. To figure that out, we have to look at the actual Homes.com user data, and the adoption rate is staggering. They reported 205% year-over-year member growth.
That is exponential.
It's crazy. They added over 4,300 paying agent members just in Q1, bringing the total to over 35,000 agents.
Right.
But, and I have to play devil's advocate here on behalf of our listener, real estate agents are notoriously fickle with their marketing spend.
Oh, absolutely. They'll try anything once.
Right. They will buy bus benches, they will sponsor local Little League teams, they will buy online leads from a dozen different websites. So are these agents just shifting their marketing budgets over to Homes.com because it's the shiny new object, or is this platform actually putting real measurable money into their pocket?
Oh, it is putting highly measurable money into their pockets, and that undeniable return on investment is the engine of this entire inflection. Management shared some very striking internal data during the call to prove this. They ran a deep analysis on the first 11,400 members who joined Homes.com. They looked at what those agents earned in the 12 months before joining the platform and compared it directly to the 12 months after they joined.
And what did they find?
The average Homes.com subscriber earned $36,400 more in commissions during their first year on the platform.
Whoa. That is a life-changing bump in income for an average agent, but what does it actually cost them to be on the platform to get that bump?
The average annual subscription cost for those agents was just $3,400.
Okay, let's just do that math. They spend $3,400 and they get $36,400 back. That is almost an 11x return on investment.
Right.
I mean, if you offer any small business owner an 11x ROI, they're going to take that deal every single time.
They'd be crazy not to.
Right.
And the macro data supports the platform's effectiveness as well. During that same 12-month window, agents using Homes.com saw their total commissions grow by 16%.
Okay, so they're growing. What about everyone else?
Well, meanwhile, the average non-member in the industry actually saw their commissions decline during that period.
Wow.
Yeah, it is creating a clear mathematical competitive advantage. And strategically, when a company delivers an 11x ROI, it unlocks one of the most powerful forces in business.
Which is?
Pricing power. Because the value is so heavily skewed in favor of the real estate agent, CoStar can comfortably raise its subscription rates without triggering a massive wave of cancellations.
And that is exactly what they did, right? They announced a subscription price increase for new customers taking effect on May 1st, 2026, which will obviously further accelerate that push toward profitability.
Exactly. The revenue side is dialed in.
Right. The revenue side of the equation makes total sense. They built a better platform. Agents are getting an 11x return, so agents are flooding the gates, and CoStar can raise prices. But wait, I'm stuck here on a logistical puzzle for the
Okay, what's the puzzle?
You're telling me they added over 4,300 real estate agents in just 3 months. Normally, when a software company scales a user base by 205% year over year, they have to build massive, expensive call centers just to handle the onboarding, the billing questions, and the technical support for that kind of surge.
Yeah, usually personnel costs go through the roof.
Right. So how did their personnel costs not explode? How did they manage to double their overall profitability while absorbing all those new users?
It comes from the hidden architecture of their efficiency, which is artificial intelligence, specifically internal AI support agents. Rather than linearly scaling human headcount to match the 205% member growth, CoStar deeply embedded AI systems into their back-office operations.
How does that actually work in practice? I mean, are these just frustrating phone tree robots that make agents yell operator into the receiver?
No, not at all. Let's look at the actual mechanism. When a new real estate agent signs up, their historical sales data, their active listings, and their headshots all need to be pulled from various local multiple listing services or MLS feeds and formatted perfectly for Homes.com.
That sounds incredibly tedious.
It was. In the past, a human support worker would have to spend maybe 40 minutes manually mapping data fields and checking photo resolutions. Now, the AI handles that data extraction and setup instantly and flawlessly in the background.
Oh, wow.
Yeah. The AI automates the heavy lifting of customer onboarding, routine technical support, and complex data extraction. By substituting pure headcount growth with AI-driven automation, they structurally improved their operating leverage.
So they essentially broke the link between user growth and headcount growth.
Exactly. They kept personnel costs flat or even down while revenue surged, and that specific dynamic lower personnel cost driven by AI efficiency was cited by the CFO as the primary driver of their massive Q1 EBITDA beat.
That makes total sense.
It's also the exact reason they were able to confidently raise their full-year earnings guidance up to a range of $780 million to $820 million.
Well, that explains the internal magic of AI keeping costs down. But they are also using external AI-like consumer-facing tools to go after the massive Zillow and Realtor.com duopoly. And the engagement metrics on their new Homes AI search tools are kind of mind-blowing.
They really are. When a consumer uses a conventional real estate search engine today, they spend an average of about 4.5 minutes on the site. But the data shows that users interacting with the new conversational Homes AI are spending a staggering 18 minutes on the site per session.
18 minutes. I mean, in internet time, that is an absolute eternity. People don't even watch 18-minute YouTube videos without clicking away, let alone browse real estate listings for that long, unless they are deeply engaged.
Right.
What is the mechanism there? Why does an AI search keep someone on a real estate site 4 times longer?
Because it completely changes the user experience from a rigid database search into a dynamic, personalized conversation. Think about it like this. Instead of a user clicking tedious drop-down menus for 3 bedrooms and 2 bathrooms, and then scrolling through hundreds of irrelevant results, they're just typing a natural sentence.
Like chatting with a person.
Exactly. They say, find me a house with a backyard big enough for a golden retriever, within walking distance of a highly rated elementary school, and a kitchen that gets morning sun.
And the AI actually parses all that.
It does. The AI instantly curates the results to match those incredibly specific human desires. It acts like a highly attentive human broker. That level of curation keeps the user hooked, and that deep engagement translates directly to high-intent actions. Those AI users are running 4 times as many searches and submitting 7 times as many leads to the agents.
So the AI isn't just a gimmick. It is fundamentally altering consumer behavior, creating a stickier experience that generates more high-quality leads for the agent who is paying the subscription.
Right. And CEO Andy Florance was very explicit about this on the earnings call. He stated that this specific dynamic, this incredibly deep engagement driven by AI, is exactly what precedes meaningful market share shifts away from legacy competitors.
So what does this all mean? We've talked about the water company commercial monopoly quietly printing cash. We've talked about the residential inflection, the undeniable 11x ROI, the AI operational leverage keeping costs down. It paints a very rosy picture.
It definitely leans bullish.
But we need to ground this conversation because there are still skeptics out there. Wall Street isn't entirely convinced yet. Let's look at the risks detailed in these sources because the execution risk on the residential side is very real. To achieve this massive growth, CoStar has scaled the Homes.com sales force up to 570 reps.
That's a huge team.
It is. And the CEO himself admitted there is an unprecedented lack of tenure in that group. I mean, when you have hundreds of brand new salespeople trying to sell a relatively new product, they usually fumble. That is a recipe for volatility and missed quotas. And on top of that, you have complex legal risks hanging over the corporate umbrella. The filings show a $99 million litigation accrual sitting on the books for the Brown lawsuit.
Right, which is related to their Matterport acquisition.
Exactly. Matterport being a company they acquired that makes those interactive 3D virtual house tours, and now they are facing legal hurdles over patents and data. They also have a massive antitrust class action against their STR division.
Yeah, that's another complicated one.
STR is essentially the industry data tool hotels use to compare their daily room rates with competitors across the street, which has led to allegations that the software is inadvertently allowing hotels to collude and fix prices.
This raises an important question, though. How does the market actually weigh these execution and legal risks against the massive potential rewards of the residential inflection?
It's hard to quantify.
It is, but often the most honest verdict isn't found in press releases or analyst notes. It is found simply by following the money. We need to look at the incredible contrast in behavior between the outsiders and the insiders during this turbulent period.
Okay, let's talk about the outsiders first. When the stock was getting punished, it was down 28% year-to-date amid the activist battle and the confusing reporting changes. The activists, like Dan Loeb and Third Point, completely abandoned their proxy fight and sold their entire stake.
They washed their hands of it.
Yeah, they looked at the spreadsheets, saw the execution risk with the new sales reps, saw the legal hurdles, and fled the perceived risk. But the insiders, the people with the deepest visibility into the actual real-time dashboard of the company, they did the exact opposite.
In a massive way. CEO Andy Florance personally purchased 55,720 shares, which is about $2.48 million of his own money.
Wow.
And he was joined by Frederick Saint, the president of Marketplaces, and Rachel Glazer, a director, who both made notable six-figure purchases on the open market.
I gotta say, you don't drop $2.5 million of your own net worth into your company's stock if you think your 570 new sales reps are about to fail.
Exactly.
Or if you think the residential profitability target is a mirage.
And it wasn't just personal capital making that statement either. The company's board authorized and executed a massive corporate stock buyback, repurchasing 11.4 million shares for $505 million in the first quarter alone.
$500 million.
Yeah, that is a $500 million bet by the company itself that the public market is fundamentally mispricing their transition.
Which brings us to the ultimate takeaway from the stack of strategic reports and financial filings. The overarching thesis emerging from the data is that CoStar is currently rated as a generational buying opportunity. The perception that this company is a value trap, a profitable core bleeding out to fund a vanity project, that's evaporating.
It really is.
Because as those residential losses officially inflect towards zero in Q2, the smoke clears. The market will finally be able to see the true combined earnings power of a company that owns both an impenetrable commercial data monopoly and a rapidly scaling, highly profitable residential disruptor.
It is a remarkable structural transition. And it leaves us with a final provocative thought to consider, specifically regarding the artificial intelligence capabilities we discussed.
Right, Leonis.
We know that CoStar's internal AI agents are already successfully managing the massive onboarding, data extraction, and technical support load for tens of thousands of residential real estate agents. It is the secret mechanism behind their margin expansion.
Right.
So if their proprietary AI architecture is already that proficient at seamlessly managing the complex back-office logistics of the real estate industry, how long until that exact same internal AI is packaged, productized, and sold directly to the massive real estate brokerages themselves as a completely new, high-margin software-as-a-service revenue stream?
Oh man, that is the kind of hidden upside that makes deep dives like this so valuable. Thank you for joining us as we unpack the data, the drama, and the underlying mechanics of CoStar Group's residential inflection. Risk defined, portfolio protected.